Aloha and welcome. This is the base financial literacy class, Essentials of Financial Wellness. The clickable links are in the description box below. Please download your class summary quiz now before we begin. Aloha and welcome to the Hawaii Financial Freethinkers Academy Financial Literacy Education for Employers and Employees program. This is the base Essentials of Financial Wellness class. This class is about 30 minutes in length, and before we begin, you should download and print out the class summary quiz. You can use the summary quiz sheet to take notes and answer the questions as we proceed through the class. When you have completed the class, send an email to hawaiifinancialacademy@gmail.com. State your name, the class you just completed, and the date. We will then email you your completion certificate. To download the class summary quiz, click on the link in the description box below the video. Select the summary quiz corresponding to this class, download, and print it out. When you have it printed out and you are situated where you can pay attention without distractions, you have a pen or a pencil, a cup of coffee or preferred beverage, please resume playing this video. We sincerely hope that this and all the classes will be of great benefit to you. We welcome your comments and invite your questions. You may email your comments and questions to us at the highfinanceacademy@gmail.com address, which is also in the description box below. We will respond at our earliest opportunity. Please pause this video and download the quiz now. In this class, we will be introducing the basics of understanding cash flow, the personal sweep account, and the tax-free cash growth warehouse. The next classes to follow will go into more depth on each of these topics, and the final class in this series will address safe money practices and retirement planning. Let's get started. Cash flow refers to the flow of money into and out of a business. If we look at our household as a business, we can apply the principles of cash flow management to our personal lives. The starting point is to know exactly where your money is coming from and exactly how much and when. Then we need to know exactly how much is going out, where it's going, and when. Basically, this involves creating a budget flowchart. By putting what you are about to learn into practice, you will be rewarded with increased efficiency of your cash flow, zero balances on all your loans and credit cards, and create a positive cash flow. That is the goal you want to keep firmly in mind. Now, once you have all the details written down, we simply subtract the outflow from the inflow, and that gives us the balance. If there's a positive balance, you have money left over after all the outflow is accounted for, you have a positive cash flow. If after subtracting the outflow from the inflow you're in the red, you have a negative cash flow. Obviously, with a negative cash flow, there's even greater need to make adjustments to rectify the situation. Statistics say that over half the workforce in America suffers stress due to financial worries. This indicates that most workers in America have a negative cash flow. Here are a couple of samples of what a budget worksheet looks like. And here are some resources where you can find more budget worksheets and instructions. The main objective of these cash flow principles is to increase positive cash flow. Once we have all of our flow, inflow, and outflow accounted for and documented, We can then see where adjustments can be made and design a budget to plan and implement them. Most people, especially those with a negative cash flow, have loans, including credit cards, as well as installment loans. Here's one place where possible adjustments can be made in order to improve cash flow. Obviously, if we're in the habit of eating out frequently, and especially if we pay by credit card, there's an area where adjustments may be made that will improve positive cash flow. If we regularly go out to eat a couple of times a week, we can save money by cutting back to eating out only twice a month. And if we can pay cash when we do, that will save additional money in the way of interest charges to our credit card. Now, that kind of thing is obvious, but here's something that may not be so obvious, and in fact, perhaps a bit counterintuitive. Let's take a closer look at all of our loans and credit cards. First, we'll list each credit card and loan. Notate the balance for each. Write down the interest rate for each. Now write down the minimum payment required for each. Not the amount we usually pay, but the minimum required monthly payment. Typically, we pay more than the minimum, especially on the credit cards, right? So now, let's figure out exactly how much we pay over the minimum required amount total for all the monthly payments. If we now, moving forward, pay only the minimum required on each of our cards and loans, then take the total amount of formerly overpayments and put that money into a separate savings account that is earning interest, we can accumulate enough to pay off one of the loans or credit cards entirely. That, of course, will free up more cash flow that we can then accumulate in that interest-bearing savings account to pay off another card or loan. The trick here is to pay off the loan that has the highest minimum monthly payment requirement first, even if it is not the highest interest charging loan. Again, the idea is to make more of your cash flow available, to make your cash flow more efficient. Eventually, with this strategy, you will pay off all of your loans and credit cards and create a positive cash flow. Personal sweep account. A sweep account is an account that stands between one account and another, and that you use to hold funds that you are about to transfer or disperse to other accounts or places. Sweep accounts can be very useful for increasing the efficiency of your money. One reason is because there is a huge difference in the kind of interest charged for different types of loans. Revolving and simple interest is relatively good. Amortized interest is bad. Amortized interest is a little tricky in that typically the lender will emphasize that the interest rate is really low and the payments are affordable. The trick is that the interest rate is basically calculated at the beginning of the loan, multiplied over the repayment period of the loan, then tacked onto the front end of the loan. Then a portion of your payment is applied to the principal and a portion applied to the total interest. Usually for the first third to half of the repayment period, most of the payment made is applied to interest and only a small portion to the principal. That's why a 4% interest car loan will cost you 12 to 15% over the term of the loan. And a mortgage at 4% will cost you over 60% of the principal over the term of the loan. Revolving or simple interest is charged monthly on the actual balance of the loan. Typically, the interest is calculated on a daily balance and then charged to the account at the end of the payment period or month. So while the interest rate on a credit card may be 13% APR and your signature or car loan may be just 4%, in most cases, you'll pay more in interest on the signature or car loan than the credit card. And here's where the personal sweep account comes in to save you money. A popular account to use as a sweep account is a personal line of credit, or PLock. These accounts are simple, revolving interest, and usually will start at a very low APR. I have seen 3% and 4% APR for PLocks that stay at that level for the first year or two, and then go up to 8% or so. And that's still lower than most credit cards today. These PLocks are particularly advantageous for paying off amortized loans, such as car loans. In order for these accounts to be truly beneficial financial tools, we must be disciplined and exercise self-control. Otherwise, we can get ourselves into more trouble while the intent is to get us out of trouble. The strategy for using a PLock to pay off an amortized loan is, once the PLock is established, we would pay off the entire balance of the amortized loan with the PLock. Now we've transferred the debt to the PLock. While it's going to save us money in interest, it will only work to really save us when properly used. That means we want to keep the interest at the lowest we can make it. Because interest is accounted on the daily balance, we want to keep the balance as low as possible for as many days as possible each month. The way to do that is to deposit our entire paycheck into the PLock as a payment each time we receive our paycheck. That's the part that takes self-control and discipline. And that's how we can keep the balance of the PLock loan to a minimum. But don't worry, PLocks come with checks. And this is where the whole sweep idea comes in. Instead of depositing your paycheck into your regular checking account, you put it into your PLock as a payment. Then, as you need money to pay bills, etc., you write a check from your PLock and either pay that directly to the bill you're paying or put it into your regular checking account and pay the bill from there. Some places won't take checks from PLocks as they typically don't work with vendors that debit your checks electronically, like Sam's Club. And yes, you can pay off your mortgage or student loans and other high balance debt with a PLock or HELock and save thousands, if not hundreds of thousands of dollars doing so. You may not be able to pay it off all at once, but there is a strategy for paying off larger debts like mortgages with lines of credit. We don't have time to go into details here now, but we are available for one-on-one counseling if you wish. Tax-free cash growth warehouse. This is our favorite. We at HEFTA are completely convinced that this tax-free cash growth warehouse strategy is the most powerful and advantageous finance strategy in the last 200 years. There is no other account that provides so many benefits with such a high degree of safety and versatility, along with the tax advantages of these accounts. A tax-free cash growth warehouse account provides a guaranteed financial protection for you and the ones you care most about. They provide a guaranteed protected liquid cash savings asset. They are given the greatest advantage in the federal tax code. They grow your cash value tax-free, and you can access the cash value tax-free. They provide for a means of self-financing with the most flexible repayment requirements in existence. And you can access the cash value without interrupting its compounding growth. Tax-free cash growth warehouse accounts are integral to whole life living accounts with mutual companies that have a non-direct recognition policy. I emphasize the living part of this description because to truly provide all the advantages stated above, the account must be designed properly to facilitate them. Now, any whole life insurance policy provides for some amount of guaranteed, protected, tax-free cash growth and financial protection for loved ones. But a whole life living account, properly designed with a mutual company that has a non-direct recognition policy, will supercharge the growth of the cash value and allow you to access the cash value without interrupting its compounding growth. Now, this is not a class on life insurance, so I will not go too deep into design here, but I will briefly explain how a tax-free cash growth warehouse account, or TFCGW account, can be used as a sweep account and maximize the efficiency of your cash flow. First, understand that all whole life insurance policies have a cash value component, but only mutual companies offer participating policies. Because stock companies are owned by the stockholders, the company must answer to the stockholders. Therefore, while they do provide a guaranteed accumulation to the whole life policies, the profits are divvied up to the stockholders. Mutual companies are owned by the owners. Therefore, the profits of the company are shared among the policy owners participating policies. As a result, while they have a guaranteed interest rate by which the policies grow cash value, they also have a non-guaranteed dividend rate that is declared at the end of each year and is then paid out to the participating policies. Most insurance companies are stock companies. So again, for the greatest cash value growth, you want your account to be with a mutual company that offers participating, dividend-receiving policies. With the standard whole life design, that is, straight whole life insurance, cash values don't begin accumulating until the third year of the policy. When the policy is designed as a tax-free cash growth warehouse or whole life living account, cash value begins accumulating the very first year. Simply put, the TFCGW design incorporates components called riders, which both contribute to the total face value or death benefit and the cash value accumulation. Of course, insurance isn't free, but the reality is that a whole life insurance policy guarantees that when you die, your beneficiaries will receive at a minimum 3 times the amount of money you've paid into the policy as premiums, and very possibly many times more than that. This is the part of the account that provides for financial safety or security for your loved ones, and by the way, that benefit is paid income tax free. One of the biggest financial issues causing stress to American employees and facing 70% of the population is that they don't have any emergency fund they can lean on in the case where they have an emergency. And if they do, they don't have nearly enough in their fund to cover the emergency need. With a tax-free cash growth warehouse account, we are basically forced to acquire an emergency fund because the premiums come due and we have to put money into the account. In the first few years, with each premium we pay, a portion goes to the cost of the insurance, and the rest goes into the cash value of the account. After about 4 years, the amount of money going into the cash value is equal to the total of the premium we pay. By the 13th year of the account, the cash value will be greater than the total of all the premiums we've paid in and more. And from that point on, we are realizing a significant annual gain over the amount we're paying into the account. The gains are continuing to be added to the cash value even if we are using the cash value to maximize the efficiency of our cash flow by means of the sweep account. By using the tax-free cash growth warehouse account as our sweep account, we gain the benefits of the sweep strategy, and we aren't losing a penny in interest as we would with any other account. But in fact, we are continuing to add to the cash value by means of compounding dividend interest. Obviously, the time we have here is limited, so this information is not intended to solve all your financial concerns. Our objective here is to give you encouragement that there is light at the end of the tunnel, so to speak. These are all strategies that everyone can put to use. I promise that is the case, and I encourage you to seek more information and help in implementing them. Utilizing cash flow principles, the personal sweep strategy, and especially the tax-free cash growth warehouse as your financial multi-tool to maximize the efficiency of your cash flow and the sweep strategy, you can create a peace of mind emergency fund, which, by the way, may be used also as a supplemental retirement income as well, while eliminating debt and financial stress. May the force be with you as you make the exciting journey to becoming a financial Jedi. Okay, as I said at the beginning, the following classes will focus on just one of each of these finance strategies and go into more depth about it. Now that we've reached the conclusion of this essentials class, please, if you haven't already done so, answer the summary class questions and then email us that you have completed the class, and we'll email you the certificate of completion. See you in the next class.